Good morning, everyone, and welcome to our today's live market outlook. It's Wednesday, 3rd of October, 2012. As you can see from your charts, if you are in front of the screens, that initial risk appetite that has been established in past 2 days is fading now, and basically the risk-off is now coming more into the play as rather disappointing comments from Spanish sources saying that the Spain might not ask for the bailout in the near term. Most likely the Prime Minister is waiting for some elections that are due in the mid of October, and then after that to come and ask. The Spanish corporate tax take has tumbled by almost 2/3 from the pre-crisis levels as small businesses fail, and a growing number of big corporations seek profits abroad to compensate for the prolonged downturn at home. These are the highlights of the current situation. The attractive tax benefits can accrue to companies to expand overseas, but from Prime Minister government, which now seems resigned to accepting a European financial rescue, the income flow is reversed. The 65 billion euros austerity measures, including the public sector wage cuts and the consumer tax hikes, has been reluctant to lean on businesses that are key to maintaining jobs when in one in the 4 Spaniards is unemployed. This is basically the picture of the Spain today, and as I said, most likely the official request for bailout will be delayed, and basically this is the shown immediate reaction in the markets, with the Spanish officials being quite keen to proceed for this. Germany was, as we mentioned yesterday, was still giving signals for some delay, and basically current situation is reflected in the markets, reflects the current hesitation and the delay in the official request for a bailout from Spain. From the other side, also quite disappointing data that came overnight from China. Their PMI services, the lowest since November 2012, and usually quite a strong services sector in China, now weakened sharply in September, and making it posting its lowest point, as we said, from November 2012, as slow growth in manufacturing finally began to feed through the rest of the economy. The official Purchasing Managers Index PMI for the sector fell to 53.7 in September from 56.3 in August, quite a significant drop, weighed by weakened construction services and transport, as well as lackluster new orders overall, according to the survey released from the National Bureau of Statistics. As said, the Chinese data are now continues basically quite low data, and disappointing releases are now bringing in China also in the focus, along with the other world economies that are currently struggling and in crisis, with of course focus on Europe and Spain as our main focus now. As said, the fresh risk on mode that has been established is now fading, as euro again failed yesterday on approach to important 128.70 level, where the gains stalled again, and a fresh slide below 129 now doesn't look very optimistic, although the pair is still within the range, and the range is established between 128 and 129.70, with currently break of either side seen as giving us a near-term direction. Cable comes under an increased pressure after a recent break below 161 support. This was the higher base of past 2 days. More negative tone is now dominating also on this pair, while dollar yen remains quite steady above 78, and the dollar Swiss regains ground after dipping yesterday to our base support at 93.30, where the footstep was found, and the pair is currently at attempting at 94 as around figure resistance, turning the near-term focus higher. A brief look at the commodities that are again under slight pressure as renewed concerns about the world economy's growth, and especially regarding Europe, put pressure on the crude oil that is now raising further the recent gains that peaked at, recent recovery gains that peaked at 193.31. With the price losing support at 91.25, now heading towards 91, while gold also remains in the near term at the back foot following a recent break and posting the fresh yearly high at 1791. Yellow metal currently at 1770, attacking the lower boundary of the past 2 days range at 1770, and with quite negative near-term studies still more focusing towards the downside, as currently gold follows the euro and the dollar is stronger in past 2 days. Today's calendar also is quite interesting, as we have a series of PMIs to be released, services PMIs. As said, the Chinese non-manufacturing PMI came at 53.7, disappointing, while also the Australian trade balance came at quite disappointing, and a wide gap of 2.03 billion Australian dollars compared to $1.5 billion gap in the previous month, and the 0.69 billion forecast today. That is quite disappointing, and basically that sends Aussie dollar against greenback further down. The latest price is around 102 as the pair dips, accelerating its losses from yesterday's rate cut from the Central Bank of Australia, dipping from the Monday's high at 104, losing approximately 2 figures so far, and being heavily under pressure. Further from Europe, services PMI from most of the European countries, Spanish one, it's already been released at 7:45 GMT's. Italian PMI services 43.8 compared to 44, more negative forecast, while Eurozone one for September is due at 8 o'clock GMT, and no changes according to the forecast seen from the previous August release. 46 is the forecast, and the August figure from UK 8:30 GMT is the housing equity withdrawal for second quarter. It's minus 8.6 billion, slightly below minus 8.8 billion previous release, and services PMI is forecasted at 53.1 compared to 53.7. Retail sales from Eurozone due at 9 o'clock GMT, no change expected for today. Our calendar is not very accurate. Minus 0.1% is the forecast. There is a typing mistake compared to minus 0.2% in the month of July. The first indicator for U.S. non-farm payrolls that are due on Friday, so in 2 days, with forecast approximately 113,000 versus the 96,000 of the previous month release. That was very disappointing. ADP non-farm employment change for September is forecasted at 141,000 compared to 201,000 in the previous month. Recall, usually the ADP is the first signal of for the non-farm payrolls. However, it proved not to be the rule, as previous month ADP came in a very positive reading of 201,000, higher than forecasted, while non-farm payrolls did the opposite thing, came at 96,000 compared to approximately 130,000 forecast. So we are going to take a look and keep an eye on this release. This is due at 12:15 GMT. From US, further at 14 o'clock, 1400 GMT, ISM non-manufacturing PMI, that is also according to the forecast seen lower today at 53.3 compared to 53.7 of the release of July. And finally, the crude oil inventories from US weekly crude oil inventories are due at 14:30 GMT forecast for today is a build of 1.6 million barrels compared to draw of minus 2.4 million barrels in release of the previous week, and that will be all for today from the calendar releases. Set number of PMIs, services PMIs are due to be released today, so focus is mainly on this, and of course the US ADP non-farm data that are supposedly the initial indicator for the release of non-farm payrolls. That is basically the key release of the week, due on Friday. We're going to take a look now at the currencies and the commodities and see the latest movements of 4 major currencies and commodities and the forecast for today's price action. As usually, starting with the euro on a 4-hour chart, if you can see it now on your screen. Yes, you can see it. We can see that the pair has been established within 128 and 129.70 ranges. The upper one offers quite tough resistance. There were 3 unsuccessful attempts at this level, with subsequent easing seen overnight and in the early hours of European session, dipping below 129 and hitting level at 128.76, testing basically the higher base of 1st and 2nd of October at 128.75. So far, this level has contained the recent reversal, with the marking approximately over 50% retracement of the entire rally from 1st of October low at 128.02. This is also range low, and the range top at 129.67. This is the yesterday's upside rejection. As said, rather neutral tone on the larger picture, as the pair is still within the range, with the more negative now seen on the hourly. However, current attempt of basing is seen so far working, though we need to see break above 129, where are the moving averages concentrated 10 and 55 days once, and basically break above this level is to attract upper boundaries, upper targets 129.37 and 129.58 ahead of 129.67. Just to mention that currently range trading requires, as I said at the beginning, requires a break of either side to establish the further direction. Of course, today's data will give us some more clues about the situation with the services PMIs, as the manufacturing ones came quite optimistic and supportive levels, better than expected, most of them. That was basically acceleration for the euro on Monday, and now we are looking for services PMIs that, of course, if they come in a better than expected way, then we might see some boost for the single currency. A break above 129.70 and 130.00 is required to confirm base at 128 and allow for a stronger recovery towards 131.70 double top of mid-September. Otherwise, we'll see risk on the downside, as this rally, this reversal is still seen as corrective of the broader uptrend from 120.42 to 131.70, with the 200 days moving average and the trend line connecting 122.54 and 125.00 so far, holding the downside. There was a brief spike lower to 128, but generally this level so far offers quite good support, and basically break below 128 would be quite bearish, as this will be signal for a stronger corrective action of 120.42 to 131.70. Rally with the 127.40 seen on a break. 127.45 is the previous high of mid-June, and the 127.39 is a 38.2% retracement of the entire rally. Of course, there is also the linear regression channel bottom at these levels, so another quite good support seen in case of break below 128, and of course a break above 129.70, 130.00 to open 130.50 zone. That is another important level towards, on the way towards 131.70. As said, range trading is still giving us no direction, so we'll be focusing on the today's releases and see the reactions of the market, of course, according to the figures that are going to be released. Sterling is losing ground after yesterday's upside rejection at 161.86. This was just above our initial barrier and near-term range top at, I would say, 161.75, but still unable to regain 162.00, with subsequent quick reversal, raising most of the gains and attacking the range floor at 161. This is the low of 1st of October, Monday's low, with the European opening action seen cable dipping down to 160.83 so far, with the weak hourly studies and of course a negative situation on the 4-hour chart as the pair penetrated the trend line support at 161.25. More negative outlook seen in the near term for possible further extension lower, as sustained break below 161 opens way towards 160.74 initial support, 13th of September low, and 160.39.33. This is the 50% retracement of the up move from 1.5769 to 163.05, along with the 160.33 as set 7th of September high. On the upside, the broken trend line currently at 161.33 offers initial resistance. Of course, we have 160.100 that the market is currently close to it as a round figure resistance, and the previous range tops at 161.75 and 161.86, and basically break above these two levels, and regain of 162 is the only way to improve the current negative structure. As said, negative tone dominates on the lower time frames and sees more potential towards the downside, unless we see a regain of previously mentioned 161.75, 162.00 barriers as the initial trigger for some stronger recovery. Otherwise, we might see some more serious corrective action of the larger up move from 152.67 1st of June yearly low to 163.08 peak of 21st of September. Also, the 163 zone proves to be quite tough resistance, as a series of attempts higher failed approximately on approach to this level. Only one brief break occurred to 163.08, and this could be also marked as a reversal pattern, as we have a sort of head and shoulders pattern with something like double shoulder, but still quite strong signals are given now for possible stronger reversal of the pair. And dollar yen continues to tick higher, I would say, in the third consecutive session, posting the series of marginally higher highs and higher lows that define the near-term uptrend on a bounce of 77.42, 28th of September low, with the latest high posted yesterday at 78.29, keeping the upside in focus, as yesterday's close of the day occurred above 78 psychological support. That gives now more credibility to the current rally. Immediate upside targets lie at 78.36. This is 21st of September high, and then 78.53. Important barrier, 61.8% retracement of the down move from 79.21 to 77.42. And basically what we are looking for is a break above 78.50 and close above this level that will give more credentials for extension towards our key barriers at 79.00 as initial psychological barrier, and then 79.21 peak of 19th of September, and 200 days moving average at 79.30. These are the key upside barriers. Of course, before this we have 78.38, so it's the equivalent to the previous high 55 days simple moving average, and the 78.75 90 days simple moving average on the daily chart. So cluster of barriers ahead of the key barrier at 79.21 for dollar yen. So far the outlook for the near term looks quite supportive, and I would say the only break below 78, which marks the higher low of yesterday, would weaken the current structure. Otherwise, we see more potential towards the upside in the near term. And the dollar Swiss, as we said at the beginning, regained some ground as a recent failure to sustain gains above important 94 barrier, where is also 200 days moving average, and the previous highs failed at 94.36, and the sharp reversal lower erased completely the recent gains, testing so far the bottom of the near-term range at 93.30 zone. These are the series of lows with the this morning one at 93.30. Yesterday's one at 93.31, seen preceding the fresh rally that so far ticked to the levels close to 94.00, broke above the near-term consolidation range top at 93.87. With the 94.00 so far being intact. 94 is also the 200 days moving average, and it's very important if we see the break above this level, and especially today's close above this level, that will give more credibility to the current rally and reattract upside the levels at 94.16 and 94.36, the peak of 1st of October 2012. Still negative structure seen on the daily chart as indicators are pointing higher. Some momentum has initially been regained, but lack of strength to clear 94.36 might question the recent near-term rally from 93.31, and the failure to regain these levels will signal the pair still within the range on the upside at 94.36 and on the downside at 93.30 approximately, as 4-hour studies are still quite weak on the border on their center lines, with more supportive being hourly studies, but still the pair did not regain 94 as our initial barrier. Still more risks in towards the downside. As said, if we see the clear break above 94 and more important, and also important 94.36, that will be quite bullish for the pair, and that will be signaling the extension of the near-term uptrend from 92.37. Otherwise, more risks in towards the downside, especially if we see a break below the recent base at 93.30, and of course 93.00 is a round figure and psychological support. That will be trigger for a fresh weakness, and probably confirm the signal and confirm the lower top at 94.36. And the crude oil is, let's take a look on the daily, 4-hour, is losing traction after a recovery attempt of 88.94, peaked at 93.31, just ahead of 38.2% retracement of the entire down move from 172 to 88.94, short of 93.65 high of 21st of September 2012, with subsequent fresh easing, now testing the lower boundary of the near-term range and basically higher base at 91.25. Brief break seen here to 91.07, and also brief break below the trend line, connecting tops at 93.82 and then 93.17. Seeing more potential towards the downside. 4-hour studies indicators are pointing lower, while negative tone dominates on the hourly chart, and sees more potential towards the downside, as loss of important 91 support will look for a test of 90.61, that is 61.8% retracement, and another static support at 89.87. Of course, before this we have 90.00 as a psychological support. On the upside, initial barrier lies at 91.80, and then the 92 as a round figure resistance, where we have also the bearish crossover of 20 over 55 days moving averages that additionally pressures the price now. And if we see the break above minimum 92 and then 93, a regain of 93 is set to bring bulls back in play, as the price currently attacks the lower boundary of the near-term range. More focus in the near term is seen towards the downside. And quick look at the yellow metal that is despite breaking briefly above the recent range and posting a fresh yearly high, still within the range as price dips as low as 1770, testing currently the current consolidation phase floor at 1770. That also marks approximately 38.2% retracement of the latest upleg from 1736 to 1791. More negative outlook seen on the 1 hour chart with the indicators still holding in the negative territory, still seeing more pressure towards 1770. Currently it's 1773.80 as the price holds below the moving averages on the hourly chart, while 4 hour one is losing momentum as the indicators are still MACD is still above the zero, but started to point lower, and the price is currently hovering in a rather neutral near-term mode around the 20 days moving average, with the break below 1770, and the close to it is 55 days exponential moving average, along with the higher low at 1763, seen as a trigger for a further move lower. However, as long as the range bottom at 1736 and the trend line support at 1744, I would say rather previous lows at 1750 and 1744 trend line support stay intact, we might see further ranging. The daily structure is still positive, but the indicators are now moving rather sideways and slightly pointing lower, coming out of the overbought territory that keeps slight pressure towards the downside. But regardless to this, the overall positive trend is still intact on the daily chart. Ichimoku studies are still quite supportive, though first signal of losing traction is seen on the break below the Tenkan-sen line, which marks the fast moving average, with the Kijun-sen now being under pressure, currently at 1771, and the cloud top at 1761, seen as a support for now. As said, further range trading is a likely scenario unless we see break above 1791. That will reattract our upper targets at 1800, psychological barrier, and the previous high of 2011. While on the downside, 1770 and 1763 are acting as initial supports ahead of 1750 and the 1744 trendline support, while break below 1736, low of 26th of September, also 38.2% retracement, could be bearish and could be signaling possible further and stronger corrective action of the larger uptrend from the latest upleg from mid-August low at 1590 that peaked so far at 1791. That was all from me for today. I hope we covered all important points. Do we have any questions? Yes, we do. Aussie dollar. As we mentioned at the beginning, the Aussie dollar is quite pressured. Just to start with, Ichimoku studies that are firmly bearish now as the pair emerges. This is daily Ichimoku. The pair emerges below the cloud. The base was around 102.90 and ticks 102. Support just ahead of 101.66. I will elaborate more on this. Let's just take a look on the Ichimoku studies that are firmly bearish now as the pair is below the cloud, and the Kijun-sen faster moving average is now below the slower one Tenkan-sen, keeping the downtrend firmly in focus. Daily structure shows the loss of 200 days moving average at 103.44 on a reversal from 106.23 peak. Basically, the pair is still on the larger picture is still within the range as the current pressure and the weakness of 106.23 now turns focus towards the lower boundaries of the range. The support and the range floor is around the 101.70 zone. We can see it clearly here with this red line, and quite a negative tone on the daily as indicators all broke their midlines. See quite a likely scenario of testing a 101.70 range floor, and a key near-term support. Break of this level would be quite bearish for the pair, as this will trigger a stronger reversal, stronger correction of the larger up move from 95.79 to 106.23. So far, we have seen approximately between 38.2 and 50% retracement, and basically 101 50% retracement will be seen on the loss of 102 and 101 65 70 supports. This is also the low of 12th of September 2012. So in case of a break lower, that is seen quite likely as the indicators are all in negative territory. Of course, the overextended hourlies are already pointing, seeing a potential as the market already stabilizes around 102 in attempt to correct the current down move, as the hourlies are now deeply in the oversold territory, with the RSI already pointing higher, breaking above 14 days moving average. That is initial signal, with the MACD still not reacting, and still no reaction on the stochastic, but generally most likely scenario will be some corrective action seen on the oversold conditions. That usually comes as the pair hits a very important support and psychological support at 102, of course just ahead of a range floor at 101.70. So we might expect some corrective action preceding fresh weakness. Generally, overall, the tone is still negative in the short term and in the near and short term, but overall the price of Aussie dollar against US dollar is still moving within the range. So we need to see break below the range floor at 101.70 in order to resume lower and look for test of the previously mentioned levels, as the negative indicators are suggesting that this could be quite likely scenario. Of course, corrective action might be preceding this rally, and let's take a look of some levels. I would say the 102 as a round figure, 102.50 as a low of yesterday's intraday low, and 102.70. This is the 102.69. The yesterday's intraday high seen as the initial. This is also the 38.2% retracement, and then 102.89. This is 50% retracement, and 103 is a quite strong barrier. We have close to it 55 days moving average, 61.8% retracement, and the lower top of yesterday, 103.21. So I would say that any bounce should be contained somewhere below 103 in order to maintain the current negative tone, while a regain of 103 and bounce above 103 would signal further delay in the bears, and probably open way for some stronger corrective action. But still, as said, we are still within the range, with the near-term action skewed more towards the downside, and looking for test of important range floor at 101.70 approximately. The question, range bars. If we are talking about chart, then yes, we have. If you mean this is the bar chart, and the more popular and the one we use is the candlestick. If you mean on this, where you can find them, every trading system must have it. If you are a client of Windsor, then you have it in your Windsor Direct platform. You can play with this. You can find any. I mean, any trading platform has this facility, as these are the two the most used and most popular. Of course, candlestick is number one, and then the bar chart is number two. If this was your question. And of course, the time frame depends on your choice. You can use any of the time frames offered, where each, in this case, candlestick, or each bar marks, in this case, 1 hour or 4 hour or 1 day or 1 week or whatever. Thanks for the thanks. Yes, we are doing this webinar on a daily basis. Of course, as I promised, we are going to do a sort of introduction of technical analysis. I believe in the soonest possible, because I had some technical issues that have been now solved, and I have to arrange with our marketing department in order to inform everyone about this. So the soonest possible we'll have it. So we'll go step by step from the very basics, definitions of trading, of the technical analysis, and the most common and the most popular indicators and oscillators used, patterns, candlesticks, and everything that is important for you to analyze the market. I believe in less than 1 month we will have this service ready, and we'll do it either on the daily basis live, which I think is quite good and suitable for everyone. Of course, there will be recorded versions for all those that will not be attending, so they can view it later and learn something out of this. I believe the soonest possible we will have this service ready. I'm working on this. Some things are not exactly and 100% up to me, so when everything will be arranged, we will start it. You will be informed in any case. Please, if you are not, if you were receiving the invitations for these live webinars, it means that we have you in our database, so you will receive the request information for the technical analysis webinar. Otherwise, please, as I said, send me your email to analysis@brokers.ltd.com, that I can add you to the list, and to be able to inform you about time and the date of starting the technical analysis live webinar session. Any further questions, please? Okay, it seems that we have finished for today with the questions. Thank you again, everyone, for being with us. Expect to see you again tomorrow, as we are regular on a daily basis. Wish you a nice day, very successful trading, and keep an eye on the releases of today's economic indicators, as they could have quite a good impact on the markets. Until tomorrow, I wish you good luck.